Greetings, hello, my name is Ginter Luther. I have worked at Curtin Securities in London and I will be presenting you the portfolio of Aegis Protocol on Binance. And I will go straight to the point. One second. Like that, perfect. Okay, so this is the portfolio. It has started in its optimization with 10,000 and it will be compared to the benchmark of S&P 500 from the first of 2020 till the 31st of July 2025 with annual rebalancing and reinvesting dividends. So this is the portfolio. It consists of Sol Ethereum, which is a combination pair, Bitcoin, which is BTC USD, ADA USD, and ETH USD. So it has Solana, Bitcoin, ADA, and Ethereum as their assets. This will be the short summary of the performance. So you can see both start with a start balance of 10,000. The end balance of Bitcoin in that 3.5 year time span would be 289,579 dollars versus close to 14,000 on the S&P side. The annualized return, so this with reinvestment, would be 155.82% annual return compared to 9.82% on the S&P, and maximum drawdown of minus 6.76% with the benchmark in comparison in the same time period being a 23.93% drawdown, which is obviously way better. Yeah. The Sharpe ratio being 2.8 and the overall benchmark being 0.41, sorry. And yeah, very low benchmark correlation of 0.19. And I will be presenting the chart. This is how it looks since the beginning. This is an logarithmically scaled equity curve where you can see here there has been low drawdowns on the S&P side, but minuscule ones in the portfolio. So you can see here the annualized returns. So during the bull run in 2020 and 2023 and the subsequent drawdowns that have also been profitable for the strategy or this portfolio, you can see these massive spikes and then slower market movements in the meanwhile, where in comparison the S&P has lost money, made money, and barely made any to this day. The sample portfolio on a 3-month span, or let's say year to date, 38.97% on the crypto portfolio versus 8.49 on the benchmark. And yeah, annualized standard deviation of 3 years would be 37.24% for the sample portfolio versus 15.16% on the ETF. Here is a more detailed description. What is interesting here is the beta, as well as the Sortino ratio, which is extremely high, like unicorn type high, and the information ratio, which is also exceptionally high. You can see here the capture ratios of 249% of any upwards move. So if the market goes up 10%, the strategy would capture on average 24.9%, and the downside capture ratio being 200%, meaning if it goes down 10%, we would capture roughly above 20. 34 out of 43 periods, which are months in this case, were positive, so it's 79.07% in comparison to 60 of the benchmark, which is also really, really good. The Sharpe ratio, as mentioned before, 2.8% and 0.41 on the benchmark. And yeah, overall, this portfolio is a unicorn in all measures. Phenomenal in everything it does, which I am proud to say. Here you can see the month-on-month comparison. For example, in January 2022, it made 12%, roughly 13. On February, it made 3.46% minus. And here and there, it's clustered. The maximum drawdown occurred this June in 2025 with 6.76% drawdown, which in total brings the overall balance to $89,579 from 10,000, which is a 29x, where you would see in comparison 2022 on a benchmark would start in a deficit of 20%, which is massive, and then would only result in 40% increase in 3.5 years, with many drawdowns which accumulate here in 18.17% max drawdown. So annualized active return, these were some columns. Cumulative active return, sample portfolio versus S&P. So here's the 3-year, and here you can see the distribution of what made the most money, and you can see here at sometimes some strategies perform better than others, and they do balance each other out. They have very low correlations, which you will see soon. Up and down market performance, sample portfolio versus S&P. Up market, above benchmark, below benchmark, total. So in all, the portfolio has performed way better at most times than the benchmarked. And up markets 69% of the time, and down markets 88% of the time, and total 77% better. Here you can see a return versus benchmark, sample portfolio versus the S&P. Yeah, so for every unit of benchmark return, so for example, if the benchmark went down 8.8%, this is how much my strategy made, or my portfolio, better to say. And yeah, it's kind of, it's demonstrating the point. It's basically obliterating the benchmark all the time, as you can see here as well, where you can see here the S&P drawdown versus the drawdown of the strategy, which basically skipped this entire drawdown event, which has been mapped from the market. Yeah, sometimes they overlap, but overall, yeah, it's a superior performance. Drawdown for sample. So you can see here the drawdowns are exactly listed. The drawdowns for the S&P, January till September, 23.93% being the maximum drawdown. And yeah, portfolio components. You can see here the individual statistics of each strategy used, CRGR, standard deviation, best year, worst year, max drawdown. So each individual strategy does have a drawdown around 20, like from 19% till 27%, but the overall drawdown of the strategy itself is only below 7%. So this shows that it's highly uncorrelated, and they do compensate each other's weaknesses extremely well, which create this high of a portfolio. So the individual Sharpe isn't high, it's usually below 2, sorry, but the overall portfolio Sharpe edges towards the 3, and the Sortino ratio is obviously through the roof. Monthly correlations, as you can see here. So for example, Sol Ethereum is low correlated with Bitcoin, ADA, and ETH, almost nothing. And the same with Bitcoin, ADA, like here with 0.15, 0.29, 0.12. So they're very low correlated with each other. Yeah. Portfolio asset performance. In the last 3 months, you can see, or year to date, or last year, or last 3 years. Portfolio return compositions with nominal sums. Risk decomposition. Yeah, so the least risky would be ETH USD, and the most risky would be a Sol Ethereum, which makes sense due to the returns. And yeah, that's pretty much the entire portfolio. Let me scroll up. So that will be the final statistics of the portfolio. I'll return to my face. 1 second. Yes, I hope you liked the presentation. We are very proud on what we did, and this will not be the finish line. We will have an intraday portfolio soon going. This current portfolio is a swing trading portfolio, which works on a daily time chart with an average holding period of 30 days. And it does have low correlations on each strategy which does compensate for the up and downs of the underlying assets. And also they have obviously differentiating entries and exits, longs and shorts. So what I will now also show is how to subscribe to our copy trading account. So for anyone wanting to follow us on our journey, what you can do is you could type in here Aegis protocol and you will find us. And you can see here we are API trading, which is automatic. And when the statistics loads, there you go. So you can see here, this is our chart of the last 30 days, where we had an initial dump due to us deploying the portfolio, Scorn's law and such, as you might know. And now it's in a comfortable surplus of 4%. So what did I do? I went onto Binance copy trading and I typed in Aegis protocol onto the futures copy trading search bar. So yeah, that's it from me. If you have any questions, message Jason or me at Gentrit Luther on Telegram, and we will talk hopefully soon. Thank you very much for your attention and your time. See you next time.